All right. Good morning, everybody. We're gonna do it again. We got Jackson Hole this week. Throughout history, it's mostly been, a little kumbaya, everybody happy, just repeating the narrative. There's been times where Powell used it to shock the market. I often refer to the mic drop moment. He was supposed to give a speech that lasted 10 or 15 minutes, and he was done in like 2 minutes, basically telling the market they weren't going to cut at all, and that they were going to remain higher for longer. It was back during the bear market just a couple of years ago. He told the market to just suck it up and take it, basically, and walked off the stage. So most of the time, they're not going to use it for any sort of shock and all. They're just going to continue to um, sing out of the same hymn book, play the same old song, keep the beat going. And this one's not expected to be any different. So, we're just looking for him to reiterate what he's already been saying. And then we'll go from there. But next week is NVIDIA's earnings on Wednesday. So we're expecting to see volatility fall into that event, something to keep your eye on. And I'm not necessarily referring to volatility like the VIX. I'm more referring to volatility as in movement, right? Volatility is just a fancy nerd way of saying movement. And so we're going to anticipate the markets will begin to consolidate, tighten up their range, and hold the line starting Monday and Tuesday for the Wednesday's NVIDIA. We saw it on its last earnings too, by the way. It was a really tight range. The markets just went sideways. For futures trading, that may not offer a lot of opportunities, but for options trading, that's fantastic. Just, grab a couple grand right off the start of the week and just kind of lay back, let the volatility commence on Wednesday. For today, we got Fed speakers, auctions, and we're going to get an interest rate decision out of China. Not really expecting that to be headlining, shocking news, right? They've always done a really good job at telegraphing. So we'll see what comes out of that. They were talking a lot over the weekend about these two different economic data points that we're getting. On one side, things are looking good, and then we get hit with a negative economic print, and then we get a couple more good ones, and we get hit with another bad one, like home construction, for an example. So things are volatile. Everybody's looking for an excuse or a reason. We still have very clear topping patterns, and that has to change. We have to come out of it first before we can make a definitive statement one direction or another. Look at the kind of week we're going to have, and it really just starts to highlight that idea that the hurry up and wait on NVIDIA's earnings next week may start early this week. We're going to get the meeting minutes from the last FOMC this week. We're going to get some jobs data, PMI numbers, and then, of course, the Jackson Hole. After the moves that we've been getting, this may throw a number of people off, right? Continue to expect these really big moves, and then we get a week where we're not getting anything like that. I took a screenshot of this. This is a complex consolidation It's a real powerful continuation pattern when it continues, right? This is one of the strongest consolidation continuation patterns that exist. But it has to follow through, right? And it looks a lot like my TRB setup, but it still needs to follow through. We got to get through this high and then the high, right? And for us, looking at the SPX, it would be this 55.70 area and then back above that 56.80 area. I often refer people to an old book by Grimes, The Art and Science of Technical Analysis. It's a good read. It's free. If you want a copy of the book, just hit me up. I found it easily online, just searching for it with a little Google search. Just helps you better understand a little bit about the price action that we're looking at. It's not necessarily a day trader's book per se, but the more you understand price and these different patterns, consolidation, complex consolidation, topping patterns, then the better you'll understand what it is that we have to see before we can have that confirmation. There has been some discussion on this pullback that we had. It depends on what time frame you're using. But when you get the first downswing that's larger than the preceding upswing, it's a warning as well, right? So a couple of different ways to approach this with some issue behind it. It was a really nice recovery, though, is a good start. Looking at things on the weekly, we had that first big bar. Great. You know, that's what we're supposed to get after a bear trap. It's textbook. It's perfect. But now what? And this is the weekly. We're back above the 10 and the 20. We're above all the major moving averages. So one thing we want to do is mark out the sell zone. Remember, liquidity resides on the other side of the pivot. If the pivot right now is last week's high, then the sell zone is the 111 to 100. And we can just mark that out as a box. This is where we would expect liquidity to reside. If there's going to be sellers stepping in, this is where they would do it. So we're not saying that it's going to sell off after it hits that spot, just that if there is a sell-off, it's likely going to happen there. Looking at the daily, we got the 10 crossing back above the 20. The 20s struggling with the 50. We need both of those moving averages back above the 50. We need the 10 back above the 20, and we want them spread out like a fork or a bit of a fan, right? Where they're all equidistant away from each other and they're all pointing to the upside. This is cumulative volume down below, and it doesn't matter what we have on the top because it's looking at the NASDAQ. So this indicator resides all by itself. Nothing else on the screen bothers it. Looking at the NASDAQ cumulative volume, if it's pointed to the upside, we say it's just net buying. If it's pointing to the downside, it's net selling. I wrapped a Bollinger Band around it. The green line is the 20, the 10. I think these colors got screwed up. That green is shaped like a 50. So I'm betting that that's our 50. I'm going to have to go in and change the code around a little bit. But 10, 20, and 50 is there. we're back above those major moving averages, and we're about to get a 10-20 cross on cumulative volume too. The problem is, though, is this high back here. So we need that net buying to pick back up. It did pretty good last week with the start of this recovery, but it needs to follow through, get through this 9 to 10 zone and start pressing the edges of that Bollinger Band again. Bollinger Band gets forced to widen, right? Price starts pressing against it, pushes it. A lot of times we see fall away and press again, fall away and press again. But the CVI is an indicator and the Bollinger Band is an indicator. So, just kind of realize we're a long ways away from price when we're putting an indicator on an indicator that's looking at price. I know it's too early for that, isn't it? Good morning, bro. We did get the spot gammas report really early this morning. It's nice when they do that. We're above the 20 and the 10-day. We're above the 10-week, zero gamma volatility trigger, and the 3-week. I mean, we're above everything, right? We got it all stacked up nice and neat below us. It's not to say that we can't go down, because price can do whatever it wants. We've learned that long ago. But the likelihood of us breaking those levels and going down is low, right? Our base case scenario is that we're going to hold the line, chop sideways, and or continue and advance to the upside. The only thing that could really get us to recut these lows would be if we get some significant negative data like we got that sent us so sharply to the downside last time, right? It was the perfect storm of negative news just piled into the market all at once, and it exacerbated the downside move, and it happened really fast. So that can happen again. It's just not our base case scenario. Volume's looking okay this morning. It's in the 60s. Considering this is August, that's not bad for the overnight hours. Certainly not as high as we've seen, last week when we had 90s. But still, it's not bad. 58 for the overnight volume. We'll take it. Looking at last week's volume profile, it's not going to do us any good unless we break below the point of control of last week, right? So it's just above the 55.50. We just kind of zoom in here a little bit. Here's last week's point of control, 55.50 down here. So we're expecting this to provide a little bit of support. It is where the greatest amount of trading took place last week. That we know for certain. Whether or not it's going to be supportive or not, we won't know until we test it, right? Now, you could argue that we've already tested it. I would say if I want to see a more confirming signal of it getting tested, that I actually want price to hit that zone. You could look at it as a VPOC at this point. But either way, it is the point of control for last week. Looks like they put a front run on it in the overnight hours, so it still technically hasn't been tested yet. I'd like to see it tested, maybe duck underneath it a little bit, recover back up through it. Just hide that for a moment. Get the central pivots. This day's central pivot is higher than Friday's. It's also narrower. A narrow central pivot range implies that if we get a breakout, that it could have legs and continue to run. But this isn't narrow enough to make that statement. We want a central pivot range that's so narrow you don't see yellow lines at all. You don't even see that gray clouded area. You just see the purple line. That's how narrow it could get. And so this isn't narrow enough. Also, the spot gamma's gamma index is at 1.2 in the positive. A positive spot gamma index implies that if we try to break out, that the breakouts fail, that it doesn't get legs. So it's two different things that are both saying the same thing. If we break out, it likely doesn't have legs, that it won't continue. We are above the weekly pivot already, starting the week out that way. Last 2 weeks, we've seen massive moves away from the floor pivot, more than 5% the last 2 weeks, back to back. So how far we can get from that weekly pivot point right now is so far away that it's not even useful at this point. The ADR range is still really wide. We're looking at an average daily range of 100 points. From the Globex Open, that means we could move 50 points higher or lower. That would make our 100-point range. Or from the Globex Open, we could move 100 points in one direction. That's what we call the ADR full in yellow. So when you see me type in that and I write the ADR full or the yellow line, that's what we're talking about. A full ADR in a single direction. If I write the ADR half, then I'm talking about these red lines here, because we're splitting the ADR in half. 50 points, because the ADR right now is 100 points. It'd be 50 points in one direction, 50 points in the other direction. Between these two red lines is 100 points. So those are the ADR half. These are the ADR full. It's a 21-day average daily range, by the way. So depending on what broker you're using, if you don't have my Thinkorswim indicator, you can hunt for it on TradingView. Just type in average trading range, and they've got one that is just like this. Just set it to 21. If you don't have an ADR, you can use an ATR. It's not as good in my opinion because it's weighted to the front end, but it still gets the job done. Average true range. And every single broker that has indicators has that one. There's still the discrepancy, however, between how far we're moving. Our average move is 100 points versus what we're supposed to be moving, which is 53 points. The daily expected move right now is 44 points. So price in a one standard deviation is telling us it shouldn't move more than 53 points in a day. The options implied volatility is saying we shouldn't move more than 44 points today. And the average daily range is saying we're actually getting 100 points. So this is a clear indication of volatility without using things like VIX and volatility tools. Because the ADR is so big, these red lines are really far apart. Right now, we're basically flat on the day. We haven't done anything, so there's no edge in trying to guess which direction we're going to go, up or down. It is worth noting that the lower edge is in the buy zone of yesterday's low, right? If we were to use the 111, snap it on here, we're just going to do yesterday's price action, or Friday's price. From 100 to 111, that would be our buy zone. And that's where the ADR half is. Nice when everything just lines up like that. So it would be nice to get some kind of test where we come down and bounce on that red, but at this point, it doesn't owe us a move like that. We don't have any reason to anticipate that we're going to get a move like that. We've got data. We need to wait on the data and then see what direction the data takes us. Ten-day, 30-minute volume profile. Nothing is expected to change in that point of control unless we stay here for the day. I think that's all it would take, right? If we can stay right where we're at for the rest of the day, then we are very likely going to see this point of control move up to our new location. Two minds on that. On one hand, it'd be a nice springboard to bounce off of and continue to rally higher. The other hand, it'll be a significant resistance and it'll be hard to get through. Now, I've talked about this before in the idea that these are zones. So once the point of control gets brought up here, it'll be a zone. And as long as we're chopping around that zone, above it and below it, then it's not a support or a resistance. It's just an area. But once we expand far enough away from it, and then we come back to it, if it was over our head, it'll be resistance. If it was underneath us, then it'll be a support. But while we're just sitting there chopping back and forth, it's neither one. That's if we stay here long enough to get the point of control brought up in the first place. It's been at its current location for what, like a week or so? It continues to stay there because we continue to not sit in one spot long enough to move it. And that's still what we're looking for. Five-day, 5-minute volume profile. We don't have a VPOC from yesterday to carry forward. And the point of control for today is over our head. That's something we would have to deal with if we're going to make another run to the upside. Remember, the base case argument is that we're just going to hold the line today unless we get some news that can shake us out of this range. But with Jackson Hole this week, we got to try to like rank in priority. What's the biggest thing the market is waiting on? And I think Jackson Hole ranks pretty high on that list. Now, last week, before the week ended, we had a chance to look at next week's point of control and this weekly range here, right? This weekly expected move. So what we did is we copied the range and we set it on the new projections. And Friday morning when I did this, it was showing that this week's range was going to be less, that there was less volatility in here. This goes back to the statement that we're expecting a sideways week. That doesn't mean that we're just going to stay in a very tight range, but it does imply that breakouts will fail and then we come back in the box. Kind of a bit like what we have back here. I think that's a really good example of the kind of week we could be looking at. It wasn't exactly a crazy tight range, but it was tight enough. And we could stretch that all the way over because even on this day, sure, we broke out, but we came right back in again. Either way, this week's range is significantly smaller than last week's range, and it implies the market is waiting on something. That's why they say things like FOMC is volatility suppressing. So is NVIDIA's earnings. We just came out of OPEX, by the way, too, and that removed a lot of the gamma structure around us. I think most market technicians are looking for a pullback at this point. Now, I showed that picture where we could just come all the way up and break it, right? It can be done, and if we do it, it's crazy bullish to make that kind of move. But it's more likely that we're going to top out here and we're going to pull back, which is okay. That it's what we need to do to maintain a healthy market structure, is to get some sort of pullback. But that's a really wide range of where it could stop. And as long as it doesn't break this low, or if we want to be, more strict, maybe that low, as long as it doesn't do that, then it's still considered okay. That's a huge area to make that kind of statement. I'd like to tighten that up a little bit. So at the very least, you could do some sort of halfback, which is 53.50. And if we did want to use, say, something like a Fibonacci, then you've got your 786. If you think about your typical market trend, those pullbacks are 786. Now, the textbooks talk about a 618. I think that's just old school stuff, back when people had 1 hour delayed charts and 30-minute delayed charts, 15-minute delayed charts. Then, using things like a 618 made sense. Sure, why not? And that's the heart of Fibonacci anyways. But I don't use 618. If we're in a trend, I want to see very clear market participants step in and take over for those who are taking profit, right? We want to see really clear, convincing signals that there are people willing to take the place of those who are leaving. So I like 786 for that identification of enthusiasm, for the lack of a better word. So 54.88. And if we wanted to tighten that up because of this really deep wick, then it's 5,500. It's a nice round number, nice and clean, clear, simple, easy to remember. I think we need to keep our closes higher than 5,500. If not, we'll come back and retest this half, 53.80, and then we'll see. Just remember, it's still considered healthy, or this move back up is still considered part of a complex topping pattern, as long as we don't break this low down here. That leaves a lot of room. Bitcoin's down. Gold and gold miners also down. And things that are up. The VIX again. Nat gas. The Mag 7's getting a little bit of flows. China ADRs. So the Baba Baidu's. It's looking pretty quiet out there this morning. All right, Baba was up a little bit. Looked like it got an inside day breakout failure. It tried to get outside yesterday's range. It was rejected. Tried again, set a lower high. Not looking too good for a long on Baba here at this point. Of course, it's pre-market flows. Baidu, it never really even got started. So from the China ADRs, they're not looking very good. I mean, bonds are up a little bit, but we need a 0.5%, and they aren't there yet. So we got a little bit of a scoop pattern here on the daily, but it's not complete. Lots of wicks on those 2 red days for the downward move. We're struggling at the halfback, so it's a key level of concern. But the failure in Bitcoin is pretty clear. Just continues to stay weak. It's interesting that even though we're down, we're still inside of Friday's range for the moment. Crude also down, coming back to that year-to-date VWAP again. All right, we got the 10-year looking like it wants to break that 3.85. That could provide a little bit of juice into the market. Let's look at this on a bigger chart. So we got a little bit of structure. 3.8. I mean, you can throw the extra decimals on there if you want to, but 3.809, 3.81. We kind of need that structure to hold. If we measure this last impulse, 3.86836. So if we see a break of Friday's low, then we really want to see this halfback hold. We want to see clear buying in this zone here, because we can wick through. That's not a problem. Just like we wicked through back here. It's also worth saying this is a halfback bounce, right? No problem. But it's not supposed to fail there, right? It's supposed to bounce and run back up. And of course, markets can't always make that run in a straight shot. So if it was going to pause, it should have stayed above the 50% of the bounce bar. And we're not doing that either. So a little bit of weakness, if we'd just stayed right in there, that would have been fine. We'd bounce up, pause for a little bit, and then continue back up to the top of the zone. But that's not what we got. So this isn't looking too good from a 10-year point of view. If we're looking for some shenanigans in the market and, see the S&P and NASDAQ come out of this zone, this could do it. And we got the dollar. This is December 28th of last year. And this is March of this year. So we broke March's low. We're getting into January's lows, that 102 area. And if that fails, then we're going to be looking at December's low. Nice round number, $100 is down there. Got a lot of drama. Just to have some close levels to work with, measure this last bounce. Put a buy zone on it. This is like a micro double bottom. Double bottoms are bear traps. So we need to go lower than the previous low to trap a bear, to get a bear convinced that we're actually going down so that we can flip it on them. But when we break that low, how much lower do we have to go before we consider it no longer a bear trap, but actually a continued move lower like we had back here? So a little micro double bottom, and it kept going. It didn't bounce. It wasn't a bear trap. So this 123.6, it's a great example of how far we need to go before we no longer consider it a bear trap. Take this same drawing, set it on this last little micro double bottom. You could see that it easily went through the 1, 2, 3, 6 and made it all the way to 100% of the range that we measured. This is what we're measuring. Plot that to the downside 100%. It made it easy, no problem. So now we've got another one forming. We could see the dollar get below 100. Add that to the 10-year, also making that move below 3.8 or that 3.81, whatever it was. I think these two combined could make some serious impact on the market. With the VIX up, we failed to stay underneath 15. And that puts us in just a pullback environment, not a low vol bullish environment. So we still need to see that VIX continue to fade. Looks like the carry trade is taking a little backseat this morning. All right, we got auctions today. Don't forget, we got a couple of Fed speakers. And it's a hurry up and wait day. Looking for Jackson Hole. Want to see clear signals that the market is done waiting. One of the clearest signals that it's done waiting is that it actually breaks out and starts going somewhere based on something other than the Jackson Hole that we're waiting on, right? So if we don't see buying in this buy zone and we continue to expand below the red line, we'll just play the range all the way down to the yellow and we'll go from there. Same thing in the other direction. If we break out of that buy zone that we had marked to the upside here, then we run it to the red line, get through that, we run it to the yellow line. It's really going to be that simple, but I don't think we're going to get it. All right. Base case, sideways. Look for flows in the market watch too, right? You want to see really clear, convincing signals of the three: consumer discretionary, technology, financials. You want those three with a lot of flows in it, preferably not just the Mag 7, but that rising tide scenario. If we look at what the overall market has done in the last 5 days, all sectors are green over the last 5 days. All of our 9 sectors anyways. Everybody be careful, be safe, watch the clock. I'll see y'all tomorrow.